The idea is really to be able to understand my reviews and previews, my newsletter. Basically, if you sat down with the tools I'm going to teach you, I think it's enough. I think it's enough to actually trade. I'm not sure you need anything else. I think that, if you have other tools you want to use, that's fine. I tend to think people get analysis paralysis because they just have too many tools. I don't think you necessarily need as many as most people use. So let's see how the magic wand is doing here. We should be all set to go. This is my background. I've been in this for a very long time. I've had the pleasure of running dealing rooms where I was responsible for a whole group of people. I did a 2-year profitability consulting job after I retired, which is actually, I made more money doing that than I ever made trading, actually. That was quite a lot of fun. But the assignment was to take a private Swiss bank and improve the profitability of the foreign exchange dealing room. And in doing so, I learned a lot about how traders think. And actually, from studying their results in detail and statistically looking at it, there's just a lot of patterns, a lot of identifiable patterns. Just some people just can't keep their money; they have to give it back all the time. Others, they just make a little bit every day, and they're just wildly successful. That's more my style, is to make a little bit every day. I think it's really important to get away from dreaming when you trade. Looking for that big magic trade, you're going to make millions of dollars, and getting down to the fact that the market doesn't move very much. It moves very slowly, and there's a little bit of money to be made every day, which can add up to quite a bit of money. And that's more or less the approach that I take in my trading. So I'm a short-term trader. I like the idea of going home without a position just about every day. When I'm trading, I'm down to business, but when I take off my headset and turn off the computer, I'm done for that day. And I never have a big opinion of where it's going to be tomorrow. I take each day as it comes, consider the focus of that particular day. What's going on right now? That's all I'm really concerned about. Probably the worst thing you can do is to have these big, full-blown ideas on what's going to happen. You really need to get down and focus on what's going on at this one moment in time. I'd like to give you about a 5-minute, 10-minute view of the history of foreign exchange. A lot of people have been in it a long time and really don't understand how it all got started. Prior to World War I, countries jumped back between fixed rates and floating exchange rates with limited success. After World War II, all the major countries got together, the United States being the only country still standing, and they all set up a system where all the currencies were linked to the US dollar at fixed exchange rates. And the dollar was fixed to gold at $35 an ounce. So all the major currencies had an intrinsic value linked to gold. A certain number of yen would be worth an ounce of gold. A certain number of dollars would be worth an ounce of gold. This system worked extremely well and helped the world rebuild itself after World War II. In 1971, the system broke down primarily because the U.S. had spent about $1 billion on the Vietnam War, and countries, particularly France, they lost confidence in the dollar and began demanding gold for every dollar they got their hands on. And because the U.S. had printed quite a number of dollars in the war effort, there's a lot of dollars rolling around. And Arthur Burns at the time was running the gold vault, and he called up President Nixon and said, "We're just about out of gold." So Nixon had no choice but to suspend the dollar's convertibility into gold. At the same time, this was in August of '71, the system of fixed exchange rate was temporarily suspended. In the immediate aftermath, the price of gold spiraled over $100 an ounce, and the value of the U.S. dollar plummeted. Most of the money, a lot of the money, found its way to Switzerland. In fact, during the 1970s, Switzerland actually had negative interest rates. Actually, if you put money in Switzerland at the end of the year, you had less money than you started with. Even today, the Swiss franc is still regarded as a safe haven currency, a place to put your money in turbulent times, when there's wars, politics, financial problems. It still has that aura about it even today. By 1973, it was clear there was really no turning back. That old system of fixed rates was gone. A new era was officially started. The U.S. officially abandoned the gold standard and the exchange rate fixed system in '73. All of a sudden, all the importers and exporters, the rates were floating around, and they had to figure out where they were going to get their foreign exchange and at what price. More importantly, they were going to get their foreign exchange. The first exchange was the CME. It was out in Chicago. It was called the International Money Market. Some people know it as the IMM. They offered contracts in the major currency pairs. There was an open outcry system on the floor in Chicago. They were just open a few hours a day, and they closed at 2:30 p.m. Eastern Time. The importers and exporters were getting their business done on the CME. And then they tapped into their banking relationships. That's how the banks jumped into Forex trading. Now the banks, they needed to accommodate some big transactions, so they set up a system amongst each other called the direct dealing system. The way it would work is all the major banks could call each other for prices, two-way prices. Even though one bank wouldn't necessarily have an interest at that time, they would accommodate the other bank because then they'd have the ability to call that bank when they had some business to do. The hours, the amounts, the conditions under which the direct dealing took place varied from bank to bank. There were some standards. That's my background. I was primarily a market maker for other banks, for customers of the bank, and I can tell you it was a lot of fun. Now, there was a problem with the smaller banks, the regional banks, because they didn't want to participate in the club. They didn't like the idea of having to make prices to Citibank and Chase Manhattan and all these other big banks when they didn't have an interest to trade. So they just wanted something where when they had foreign exchange business to do from their customers, they could call somebody. And the big banks said, no, if you want to be in the club, you're in the club. If you're not, you're not. So this is where the brokers came around, the first Forex brokers, what they call the voice brokers. That's where I got started in the business. I got started back in the late 70s. This system worked for everybody. The bigger banks made the rates to the brokers, and the brokers made the rates anonymously to the regional banks. The big banks, they made money because they made the spread, and they also saw the flow of the business. The regional bank benefited. They only had to participate as a market taker and not a market maker. And of course, the broker benefited by earning the commissions. About 20 years later, we come up with the electronic brokering system. These two systems, the EBS and the Reuters, that's what the banks use. That's where they put all their business in. The closest thing to a central exchange, since we don't have a central exchange, the closest thing is the EBS for many of the major currencies, and for certain currencies like Aussie and pounds, it would be the Reuters dealing system 3000, or just the nickname, the Reuters. If you wondered where the prices come from that you get from from your dealer platform or from your broker platform, they come from the banks. Usually a broker will have 10 or 15 banks, depending on the size of the broker, or maybe just a few banks, and it sees the rates the banks are making, and then the broker makes rates or the dealer makes rates around the bank's rates it receives from the banks. So if you can imagine, if the broker receives 10 or 15 different rates, he's probably seeing a price in euro dollar between all 10 of them, a best price usually over 1 pip spread, a 1 point spread. So they'll see 10.11, they'll make us 10.12 or 10.13 or 7.10 or 8.11. They'll make something around the prices that they're seeing from the banks, and the banks are getting their prices by looking at the EBS machine, and the EBS machine in euro dollar is usually a 1 point spread, and it's usually good for 30 million or more, 30 million euros, say, on each side or more at any given time. The retail, I guess we call ourselves retail, this business started in 1998. It's still growing very quickly. Right now there's hundreds of retail foreign exchange price providers. They call themselves brokers or dealers. Where we're going, though, is the ECN, the Electronic Communications Network. This will become the platform of choice of retail traders probably this year, next year. By 2007, I assume we're going to see a lot of the brokers that are in existence now going out of business. The idea of here's a 3 point spread, knock yourself out, and I think that kind of a system is going to go away very shortly. Something more like put your bids in and put your offers in, and other traders can deal on them with very tight spreads is where we're going. Right now you have COSFX, EFX, Hotspot FX, MB Trading, I believe, is another one. They're just starting to really take off now, and as the retail trader gets more sophisticated, they'll demand a better price. They won't be willing to deal on these prices that are out there. So that's where we're going as far as the brokers go. How do you get started? You need to learn the business. You want to know why the currencies move and when they move. You want to be able to anticipate the moves. You want to actually feel them coming. You want to get it, if you're going to trade a particular currency pair, you want to get it to know it as well as you know your spouse. You want to know it, every little detail of how it works. Each currency has a certain personality. You need to find that personality and deal with it in the context of its particular idiosyncrasies. In terms of your trading future, if you can learn to make money in a consistent, low-risk manner, you can manage money for others, literally millions of dollars. The bank pays about 6% a year these days. If you can consistently make 18% a year, I think more money than you can shake a stick out will be available for you to trade. I think there's plenty of money that would love to make 18% a year or anything near there. The usual payout for you would be 30% of the profits. It requires a real track record. Talking the talk doesn't work. You have to walk the walk. So you would need to have a track record, your own account for a rather long period of time, perhaps a year, consistent profits, no big drawdowns. What's really key is drawdowns. People really look at, people who are going to give you money to invest want to know what kind of blow-up factor do you have. It doesn't matter if you've made a ton of money if you're taking a ton of risk, because if that's the case, sooner or later you're going to blow up. So that you're not going to get money even if you make a lot of money, but you have wild fluctuations in your account. You need to settle on some kind of a trading system, trading plan, trading strategy, and then you need to stick to that strategy and show from the trades you're doing that there is some kind of rhyme and reason to what it is you're doing. You don't have to tell people exactly how you trade, but what they're going to be looking at is how big are your worst losses, how small How big are your biggest losses, and how big are your losing streaks? What we call peak to valley, which means how much do you lose without having a significant winning streak. It's not a case of you can lose 10 in a row, win one, and lose 10 in a row, and say that the 10 in a rows are independent. People see beyond that these days. They look at peak to valley, and they look at strings of profits or loss, not just individual winning days or losses. Your first step, you want to learn how the currencies move. This is a technical question. It requires looking at the price moves. You have to quantify them and qualify them. You want to learn why they move. This is a fundamental question. Fundamentals drive the Forex market, not price charts. Price charts are just a history. They're a lagging indicator. You need to absolutely need to learn when they move. Start with when the people from the country are awake. Then look at the news and the aftermath of the news. Those are the things that'll tell you when they move. It's as simple as this. If you're trading the euro, expect a lot of good quality price action around the European opening. If you're trading the yen, expect a lot of good quality price action, high volume, good tradable time to be around the Japanese market opening, when the Japanese stock market is open. And it's the same with each currency. It's when their people are awake, when their bank traders are in the office dealing with the clients, that's when all the real business goes through, and that's when the real quality moves occur, because they're based on very high volume. I see this seminar as the beginning. In terms of your investment, I believe it's $895. I would value the next 2 days at about $225. In terms of what you're going to get, what I plan on giving you, we're going to start by setting up a structured, systematic way to view and trade the market. We're going to create the tools you need, the charts, the indicators, the information sources, the right broker. We're going to practice trading the market in a systematic way. We're going to continue your training after these next 2 days with a daily review and a daily preview and review and a news trading publication. We're going to provide a written instruction manual, which will essentially be the next 2 days in written form. We're going to provide a CD of the seminar to study carefully and completely. And we're going to follow up with a free seminar to answer your questions, clarify your uncertainties, test your trading skills, and perhaps, time permitting, go into more advanced concepts, go into another level of trading. I chose not to go too far these next 2 days because my gut feeling is a lot of the people here would not be able to handle too much. So I'd prefer to go quality to teach you exactly the Euro Trade, a complete trading system. And then in the follow-up free seminar, which will be in approximately 5 weeks, the idea is I'd like you guys to spend a month with the review preview, spend a month reading the News Trader, spend a month watching and following the system, and then to come back and we have another meeting. We will contact you about questions. I want to take all the questions we get. Hopefully there'll be a whole bunch of them. I want to group them by category and then teach another seminar that encompasses all those questions. It's important to me to get your questions because then I'll know where I'm not getting my point across or where I'm not being clear, and I can redo my seminar. And the idea being, I'll make a better seminar if I choose in the future to do this again. Now everyone is unique. Let's start with having the right perspective. This is very, very important, and this thing is a little jumpy at the moment. Let me go back here. It's getting a little crazy. Okay, we need to start with having the right perspective. Every day, every single day is unique. Every single day is totally unpredictable. There are forces at work in the market that nobody can know. The perfect trade can be a disaster due to factors that cannot be anticipated. What I mean here is that what really drives the foreign exchange market, in addition to the news, in addition to the actions of the hedge funds and the banks, is the importers and exporters. In the U.S. alone, we're talking $8 trillion per month is transacted just related to the normal flow of imports and exports. When these guys choose to come in and buy their euros to pay for their German cars, or buy their yen to pay for their video machines, or buy any currency, you never know. And a lot of times these transactions is nothing more than the accountant or the CPA that's working for a firm figuring out what the numbers are for this month and saying, okay, I need to buy a bunch of euro or sell a bunch of euro. In addition, you have mergers and acquisitions. You probably hear a lot recently about the UK and companies being bought in the UK, and this creating a tremendous demand for the pound. This happens every day in every currency. Another huge part of it is the options market. There's a huge options market. So there's always a lot of things going on and it's all done over the counter. It's not on any exchange. There's so much going on we can't possibly know about, that even the most perfect trade looks perfect from a statistical point of view, perfectly from a technical point of view, perfect from a fundamental point of view. The news is perfect. The sentiment seems all primed. This looks like a perfect trade, and it can go wrong. And the reason for that is simply that there's other factors intertwined in there that we just cannot know about. So we have to accept the fact that any one trade on any one day doesn't matter. It's very random. It could just turn out to be a loser even though you did everything right. And that's why, we talk a lot, I talk a lot about a daily stop loss limit. So that people, I hear people say, well, I speak to someone last night and they said they held a trade and lost $19,000 on one trade. And they said, I shouldn't have done that, and that's why I've come to you, because I have to get better at this, and and he explained why he thought it was the perfect trade. And it could be the perfect trade. It could be that the trade is too good. By that I mean everybody else has that same trade on because it looks too good. And that alone, as you know, is enough to cause the market to go significantly the other way. So the idea is, if you're a short-term trader, you got a daily budget, you're working within that, you know where you're going to put your stops, you don't go over your limit no matter what. I think the absolute worst mistake you can make as a trader at any level is to move your stop once you've decided on your original stop in a worse manner. I don't see anything wrong with trying to take less risk by moving your stop in the other direction, but never, ever, I think it's justified to move your stop further against you. The fact that your trade is going in the wrong direction should tell you that increasing your bet by moving your stop against you further is really silly. It's probably the most overdone and overworked mistake the young traders make. They feel they're always getting thrown out by the broker or always getting thrown out by the banks. Somebody's always doing it to them, so they feel this need to try to run away from the market. The fact that your trade's against you should be enough reason to cut the trade. You agree beforehand on your level, and that should be your worst case. That should never be negotiated. So losing trades are therefore inevitable. More winning trades than losing trades and a profitable month is what I strive for, what the Euro Trader system tries to do. We look to win 3 and lose 2 every week on average, so that we're a net winner of 1 over the course of a week. By allowing for 2 losing trades a week and 3 winning trades, our system is very realistic. This is not, I get every trade right every time. Now, having said that, and without sounding a little braggy, if I am, I apologize. This morning I was eyeballing my news trading system, and believe it or not, 30 of the last 33 trades have worked. So 90% of the trades that actually was signaled since 3 months, 4 months ago, they've worked. So the system has a very, very high probability to it. We're going to spend this entire day today talking about technicals, practicing technicals. I've got once I go through my process, I have a month and a half, the last 6 weeks up through this past Friday of my daily review preview I want to share with you. My idea is that even by the end of today, you'll be a robot at using the EuroTrader technical trading system. You'll know it inside out. Now, that doesn't mean that you can't use your own tools along with it. That doesn't mean you can't use this system as a confirmation for your own system. What it does mean is instead of talking about a lot of things, we're going to focus on the few things which the EuroTrader system focuses on and get to know them really well. And I believe we can accomplish that by the time we're done today. I want to talk very briefly about a trading plan. I believe money management is really key. Let me give you a profile of where I could see a serious trader going using this system. Let's look at a profile of the first month. You have a starting balance, you have a staring balance of $10,000. You have a trade size of either 100 or 200,000, so 1 or 2 lots. You have a daily stop limit of $1,000. You do very few trades a day, 1 to 3. Most trades, your stop loss is going to be between 30 and 45 points. You have a weekly minimum profit target, $425, and a monthly target of $1,700. Now that may seem strange that it says you got a daily limit of 1,000, but you're trying to make 425 a week. But you'll find that you need some room to play. You can't try to skimp. You got to have money to play, especially if you're going to trade currencies other than the euro-dollar pair. If you're trading the pound-dollar pair, generally it takes 2 or 3 trades to get it right. There's a lot of moves there's just a lot of moves in that currency, for example, and you're going to get some of them wrong. You need to have enough money from a daily stop loss point of view to hang in there until you get it right. When you get it right, it's usually a 100-point move. So if you lose 30 points on the first move and you make 100 on the second, yeah, you're in good shape. And if you get out a little early on the second, you'll be in good shape. This is what I view a typical week could be like. Lose 300 on Monday, make 300 on Tuesday, lose 450 on Wednesday, make 575 on Thursday, and make 300 on Friday. So you lose 2 days rather significantly. You have 2 days where you make pretty much the lowest number and maybe 1 decent day. So for the week you pick up your 425, and for the first month you'd be on target to make 1,700. Now after 3 months, if you were to make 1,700 a month, 425 a week, you'd be up to 15,100. At that point, you can raise your daily stop loss limit to 1,500. You can raise your weekly minimum profit target to 600. And 4 weeks a month, we're looking for 2,400 a month after 3 months. After 6 months, if you were able to accomplish that, you'd be up to 23,300. At that point, you raise your daily stop loss limit to 2,000. You raise your weekly minimum profit target to $800, which would raise your monthly profit target to $3,200 a month. Now we're starting to get to numbers where if this was going to be your job, it's starting to move into the area where you could realistically trade for a living. And keep in mind, your balance is still relatively small, just $23,000. Sorry about that. Got to get a little used to this. It goes awfully fast. Okay. After 9 months, if you were able to keep according to the plan, make $800 a week, you'd be up to $32,900. At that point, you'd raise your daily stop loss limit to about $2,500. You start looking to make $1,000 a week. Of course, with a daily stop loss limit of $2,500, you'll be trading several lots, and that would move your monthly profit target to about $4,000 per month. A year down the road, you'd be up to $44,900. At which point, again, you'd bump up your daily stop loss limit to a very sizable number, $3,500. You're still looking to make just $1,500 a week, but that'll bring you up to $6,000 per month. At the level of $6,000 per month, I think you're getting into the area where you could almost do this for a full-time job. As your account balance grows, you would continue to raise your stop loss limit and to very gradually, and that's the key point here, very gradually raise your weekly profit target. When you have a very conservative weekly profit target, you tend to attain it. You tend to get the job done. When you have an unrealistic target, you tend to overstay your trades. You tend to be looking for a home run all the time, and you'd be surprised that you wind up going absolutely nowhere. So I just wanted to give you a little idea of a very serious trading plan. For those of you who've got 1,000 or 2,000 and you're looking to make these kind of numbers with that smaller balance, it can be done. I wouldn't say it can't be done, but the idea is you wanna take it a little slower, but it would be a much more difficult task. Trying to get from 2,000 to 45,000 is a 2,200% return over the course of a year. For someone relatively new at something, to make a 2,200% return, although doable, it's not. I think it's getting beyond the realm of being practical. It would seem to me you would pick up a lot of bad habits being overly aggressive to try to do that. All right, let's get down to some trading. Let's start looking at some of the technicals. Well, first of all, just so we can plan out today, what I plan on doing is teaching for approximately 1 hour and 30 minutes, taking a 15-minute break, teaching for another hour and 30 minutes, taking a 15-minute break. Actually, yeah. Then we'll probably have a 45-minute break after the first 3 hours, like a lunch break. Then go for 1 hour and 30 minutes, take a 15-minute break, and then go for 1 hour and 30 minutes. And we should finish roughly at 7:30 p.m. So in approximately 7 hours from now. Okay, think three-dimensionally. This system is not a technical trading system. It's not a fundamental trading system. It's not a gut feel discretionary system. It's not a system that focuses exclusively on market sentiment. The system considers all these factors simultaneously and provides systematic guidance on what and how to trade on a particular day. I think it's a mistake to tear the system up into pieces and say, I'm just going to trade the news, or I'm just going to trade the technicals, or I'm just going to trade the market sentiment, or I'm just going to trade discretionary. I think you want to use all of it. I think you need to take the journey with us over the next 3 months, possibly longer, to really learn this whole system and learn to think in 3 dimensions at once, because the market truly is occurring in 3 dimensions. And when you try to just look at the technicals or just look at the fundamentals, you're just looking at a part of the picture. The idea is to look at the whole picture and consider it all as one, and then it just makes a lot more sense in terms of the way the market's flowing. The idea is you want to get in sync with the market. In order to get in sync with the market, you must consider all the things that are driving the market, and the technicals, the fundamentals, they're both always occurring at the same time, so they need to be looked at, and also the market sentiment as well. It's all occurring intertwined at once, so you need to consider all three at once to do it correctly. Where to start? The first question you need to ask yourself is, what kind of a day will it be today? Is it going to be a range day? Because if it is a range day, you need to take those profits quickly. Otherwise, they're going to disappear, because there's not going to be that much there, because it's just a rangy kind of a day. You need to think about buying support. You need to think about selling resistance, because it's not going to go too far and it's going to reverse. That is what a range day is all about. About 65% of all the days are range days. Is it going to be a big day? If you believe it's going to be a big day, you want to let your profits run. You want to anticipate breakouts. Big days occur about 20% of the time. You may get one big day a week. Other days, that's when it's not really a range day per se, and it's not a big day. They occur about they occur the least of all three. Usually, according to the way I've determined it, it's either a range day or it's a big day, and the other day is just a very unusual occurrence, maybe 15% of the time or less. Here's a euro-dollar 5-minute chart from September 29th. I want to talk about a trading day. We talk about, people say, you know, a 24-hour day is the trading day. I use a 24-hour trading day, and the 24 hours I choose to look at to define my trading day. For example, when I'm talking about Friday, September 29th, I mean from Thursday 5 p.m. That's what I consider the opening to be in Eastern time. If I forget to say it throughout the presentation, I'm always talking about Eastern time, till 5 p.m. Friday, which is 24 hours, but my trading day will always be the same. In terms of all the statistics I've compiled, I always think of the trading day as starting at 5 p.m. and ending at 5 p.m. So for example, on the only day that's different is on Mondays, because you have Friday. But I do it the same way. I take the close of business as of Friday night, and I say that's my opening for Monday. That's how I choose to do it. I want you to know the ground rules, so when we're talking about the various systems, it's not confusing. When I talk about a trading day, I'm always talking about from 5 p.m. to 5 p.m. Eastern time. So when I talk about the high of the day, I'm talking about from 5 p.m. the night before in Eastern time through 5 p.m. the day we're trading. When I'm talking about the low of the day, I'm talking about the same thing, from 5 p.m. the day before till 5 p.m. of the current day, all in Eastern time. The reason I choose 5 p.m. is, well, most of the brokers, if you have a trade open as of 5 p.m., they're going to charge you or give you the interest, actually charge you and give you the interest on your pair. When I was in banking, that's when the shift changes from the day shift to the night shift. I think the market in general considers 5 p.m. to be the end of one trading day and the beginning of the new trading day. In terms of the clock, The New Zealand and Australian traders are already at their desk by 5 p.m. and by 7 p.m. they're joined by Japan. At 2 a.m. Eastern Time, Europe joins the mix. An hour later, at 3 a.m. Eastern Time, London joins the mix. And then around 7 or 8 a.m., the U.S. and Canada join the mix. And by 11 a.m. Eastern Time, Europe has gone home. It's 5 p.m. over there. And there's pretty much nobody left. The only one left is the U.S. The Aussies, Japanese, and New Zealand are all asleep. The European and London traders are on their way home, probably more accurately on their way to the bar. No offense meant there, but when I was a trader, that was part of the ritual. I traded and lived in London, and it seemed like that the first stop was always to the pub for a pint before we headed home. Kind of take the edge off of it. So there you have it. That's your trading day. Here's your percentages. Now this is looking at the euro-dollar pair, and I will give you the percentages for all of the pairs as part of this presentation, as part of some of the documentation we'll give you as a follow-up. A range day I define as within 0.5% up or down from the opening price. So if you add 0.5% to the opening price or subtract 0.5% from the opening price, you'll find 65% of the time you will not get beyond those levels. So in a given week there's 10 highs and lows. There's 5 highs and 5 lows each week. And what I'm saying is 65% of the time, so 6.5 out of those 10 highs and lows, 6.5 of them, and I know a half is not possible, but it is in statistics, 6.5 of them, it's not going to get beyond 0.5% one way or the other, the absolute extreme price of the day in the euro-dollar pair. The big days, what I call the big days, which is up or down 0.75%, which is really about 100 points in euro-dollar, which is a big day for euro-dollar, to move 100 points from that 5 p.m. price in either direction. That would indicate a big day. That's going to happen 2 times on average per week. Out of the 10 highs and lows that are created each week in the euro-dollar pair, 2 of them will be of 100 point or more nature. Now the other 1.5 roughly is going to be days where the extreme high or low is somewhere between 0.5% and 0.75%. So this kind of gives you a little statistical feel for how much the euro really moves, because that should have a direct bearing on how we trade. I'll be telling you each day what kind of a day I think today is, and we'll define how I arrive at that, and you can agree with it, you can disagree with it, you certainly can modify it. You certainly could email me and say, have you ever considered this? Because I would like to consider this. I can only consider what comes into my brain, and I actually have a very small brain, so there's only so much I can think. So if you have ideas, I would love to hear them. I'm sure the group would like to hear them. So don't be bashful about sending emails with ideas. You know, I believe this system is excellent. I think it's probably, in my opinion, the best of its kind. But I think that always there's something better out there. There's some ways of improving it, and anybody who wants to make a contribution would be certainly appreciated. In terms of defining the range day, the high for the next 24 hours will be 0.5% or less from the opening price, and the low for the next 24 hours will be no more than 0.5% minus from the opening price. So for example, if the euro dollar, the opening price, the 5 p.m. price is 128 the figure, 128 even, then I multiply that that number, 128 times 1.005, and it tells me the high will be 128.64 or less, with a 65% probability that I'm right about that. And on the low side, it would be 0.995, take away a 0.5%. So I'd multiply 0.995 times the 128 number, and that would tell me that the low will be no lower than 127.36, with a 65% probability overall without considering anything else. So what I'm getting at is 65% of the time the days high or low are within a 0.5% of the opening price. This is what the statistics show me. Most of the time, that's all you're going to get. It's going to stay in a real tight, narrow little range throughout the whole day. The extreme price, starting with that pivot point, if you will, for lack of a better word, of the opening price, the 5 p.m. price the night before. Now, defining a big day. What do I mean by a big day? A euro-dollar big day. In that case, I'm saying that the high for the next 24 hours from 5 p.m. Eastern Time to 5 p.m. Eastern Time, from that opening price at 5 p.m., the day before, if you will, or the night before, whatever you want to call it, will be at least 0.75%. So I would multiply, in this case, the 128.00 times 1.0075, and it will tell me that the high will be at least 128.96. So when I say that I believe today is going to be a big day, I'm saying I expect euro-dollar to move up 100 points or move down 100 points from that opening price, which is quite a significant day. I assume you can see that on a day like that, taking a 20 or 30 point profit on a good trade may not be the wisest move you can make, because there may be room to take 50 or 70 points profit on a trade on that day or more. So deciding beforehand whether you think it's a range day or whether you think it's going to be a big day should have a significant impact on how you go about trading that day. So 19% of the time, the days high or low are outside 0.75% of the opening price, a big day. So what I'm saying is this: 19% of the time, approximately twice a week, there's 10 highs and lows a week. 2 of them, could be 2 highs, could be 1 low, 1 high, or 2 lows, but 2 of the 10 events, highs and lows, that occur in a given week, 2 of them are going to be of that 100 point up or down from that opening price nature. Those are the big moves. Now, one easy, most of these big days and big moves, not all of them, but most of them are going to be news. Most of them are going to be events that cause these bigger moves. So one thing we look at when we're deciding beforehand whether it's going to be a big day or not, we look at what the news is are going to be out for that day, and that gives us a pretty good idea that it's an early warning signal that perhaps it's going to be one of these big days. On a Monday, if there's no news out of any significance, the chances of it being a big day are going to be a lot less than on payroll Friday. On payroll Friday, there's 2 reasons to think there's a lot of jobs. It tends to produce bad numbers elsewhere in the economy, and it trickles down eventually to the exchange rate. So news would be one reason to think a Friday could be a big day. The other reason that big days occur on Friday is because the market actually closes on Friday. So it's the people who generally go against the bigger moves, so to speak, the people who try to trade against the bigger move on a given day, will tend to be absent on Friday because they don't want to leave their trade open over the weekend when they don't know what's going to happen. So from a technical point of view, if the euro dollar has moved a certain amount on a given day, if it's Monday or Tuesday or Wednesday or Thursday, there's a lot of traders out there that'll say, okay, I'll take the other side on that trade because I think it'll come back over the next few hours or in the next period of time. Now on Friday you don't have that luxury because the market actually closes. So if somebody is just a day trader, they're forced to close the trade at whatever price is available Friday evening. And as a result, you'll find that on Fridays a lot of times the moves will be much bigger, and it's not unusual to close within the top 20% or the lowest 20% of the day. So if you were to just look at a chart that just showed you the Friday bars on a daily chart, you'd see it seems to be very decisive on Fridays. The bar, if it's a candle chart, the bar is either mostly green with very small wick, or it's mostly red with very small wick. You'll find, or you'll see it'll tend to close near one extreme. One side will have a very small wick consistently on Fridays. So these are some of the things you want to be thinking about even before you think about putting a trade on. The very, very first thing is you should be thinking about the night before. By 5 p.m. the night before, when you have all of today's information to work with, when you start thinking about tomorrow, the first thing to consider is, what kind of a day do I think it will be tomorrow? Now another thing to consider again is that the price moves on the big days are sustained. As you can see on the big days, when it has a big daily price move, it tends to close at those extreme prices. And the same on the downside. When it makes a big move on the day from the opening, it tends to close at those extreme prices. So you want to stay away from the idea that it's too high or too low. On the days where it's moving quite a bit, it tends to sustain them. Now in terms of the Jimmy's bands, which we'll talk about, my proprietary trading bands, I take this into consideration. That's why if it gets above 0.5%, I believe it has a much better chance of becoming one of these kind of days where it just keeps going quite a bit more. And that's why I like to cut off my trades once the market's moved more than 0.5%, because then it has more than a 50% probability, according to the numbers I just showed you, of turning out to be a big day. Just to recoup the numbers once more, roughly 65% are going to stay within that 0.5% profile. 20% roughly are going to be big days, 100-point kind of days, and only 15% are going to be other kind of days. So what I'm getting at is I like to cut it out at that 0.5%. Once it gets outside that 65% kind of a day, I like to cut it out because I don't know whether it's going to be an other 50 to 75 or a big 75 or more, but there's more big than other. So I kind of feel once it gets above 0.5%, I like to cut my trades out if I'm trying to go against it and just assume that it's going to keep going. And we'll talk about this. We'll talk about the idea of trading on the assumption it will keep going and what I see as the strengths and weaknesses of that. We'll get to that shortly. Let me define the other day. The other day is when the high for the next 24 hours will be between 0.5% and 3/4 from the opening price. So I simply take the half number, the 3/4 number, and that would be that mid-range. So I'd say 1.0051 to 1.0074, and I come up with this. This would be the other kind of a day. And on the downside, I would multiply rather times 0.9950 and 0.9949 and 0.9926. And that will give me that little range in between these other kind of days where they're not quite little days, or they're not quite range days, they're not quite big days. There aren't that many of them. But they're not, I don't have any statistical relevance for trying to trade when the price turns out to be an other kind of day. So in terms of me answering that question, what kind of a day is it going to be? I either say it's going to be a range day or it's going to be a big day. Those are my two criteria, and there's specific ways, of course, to trade each one. So 16% of the time, you're going to go in this little area here. And like I said, I don't see any statistical way to trade that little area there. If it turns out to be that kind of a day, that's just what it is. I don't have any strategy for those kind of moves if that's all it can get on a particular day. As you can see, that area in the middle, that is almost totally black, which is the 0.5% up and 0.5% down. That is the area I focus on. It is the area that 3.5 out of 5 days a week are going to be in, and that's where I believe the real money is. And it's not chump change either, because you're talking about in there 0.5% up and 0.5% down in euro. You're talking about 125 points of total range, and there's plenty of room in there to get 30 or 40 or 50 or 25 points per day out of that very easily. And when you think about 25 or 35 or 45 or 55 or 65 points a day, when we don't necessarily have to say 25 or 35 or $45 or 250, 350 or $450. We should think about it more in terms of 25 points times a certain number of lots, or 55 points times a certain number of lots equals a certain amount of money. In terms of forecasting what kind of day, I start off with the premise at 5 p.m. At 5 p.m. each night I sit down and say, what kind of a day is it going to be tomorrow? And I assume every day will be a range day, because frankly 65% are, so I might as well start there. Okay, every day is going to be a range day unless the prior day was a big day. Now this sounds counterintuitive. However, the statistics show me that when you have a big day, it is oftentimes followed by another big day. And since only 2 of them are going to occur, just 2 per week are going to occur, the fact that they occur one after another quite often, yet in total for the whole 6 years only occur an average of twice per week, it tells me that I want to be on the lookout for big days on a day following a big day. Now, from a more practical point of view, usually a big day is caused by news. So let's say on Friday we get a big day because of payroll. Well, then Monday may turn out to be a big day as well. And it kind of makes sense when you think about that, because price will either accept the new levels, new significantly different levels, and perhaps go even further in a significant way, because the news itself could be very significant. Or the market may decide that price move on Friday was well overdone, probably related to the lack of market makers willing to take the other side on Friday, and hence you can get the ball rolling back the other way. And a lot of the positions established on Friday from a fundamental point of view with conservative stop losses tend to all get stopped out on Monday, and hence you wind up with back-to-back significant moves in the euro-dollar pair. So my first criteria for disqualifying a day as a range trading day is when the prior day was a big day. And this is not too hard to figure out. You simply look on the prior day. You say, where did it open the prior day and where did it close? And was there a 0.75% change between 5 p.m. and 5 p.m. the prior day? I do this on a spreadsheet. I'll be showing you that a little bit later. The only other thing, just one other thing, would lead me to believe that today will be anything more than a range day. And that is something I won't know until it actually happens. And that is if there's key news that is released and that key news is tradable according to my news trading system. Because my news trading system tells me that this was a significant difference that in the past has consistently resulted in a big move. And a big move, I mean at least 50 points or more. So a big surprise. So and it has to be a key news release. So when I'm looking at my news trading system, a lot of the indicators have what I call a 50-point price projection. I expect it to go at least 50 points from the price right before the news in a directional way. So if the news is bad for the dollar, I expect the euro dollar to go up at least 50 points. So rather the pound dollar is what we trade these days. So the pound dollar to go up at least 50 points. If the news is bad for the dollar, I would expect, if the news was good for the dollar rather, I'd expect the pound dollar to go down at least 50 points, or the euro dollar, say, to go down at least 50 points. So in that case, I know what you're thinking right here. You're saying, well, pound dollar and euro dollar, the pound usually moves more. That's true. I agree with you. But in terms of the way I look at it, in terms of the way I analyze it, I look at the euro dollar pair in terms of determining big day and small day. But I feel that the key news releases, and there's probably 20 of them, about 20 of them only. So possibly there's, on average, there's one a day. They don't always happen each day. And of course, when you're looking at a currency pair, you have to consider both. So if you have a key news release for the pound out, you could assume the pound would have a shot at a big day if it has a 50-point indicator that was tradable. And if you're looking at the euro-dollar pair, and it happens to be the day that Trichet is speaking, well, if he says the wrong thing, you could assume that that could be a big day. So in advance, you could say to yourself, this could be a big day today. You would term it a range day. The only reason not to start the day off as a range day is if the day prior was a big day. Otherwise, you start off every day as a range day. And then when the news events actually are released, if they turn out to be tradable, then you shift gears for the rest of that trading day and say, now I trade this as if it was a big day. So for example, if you got the 8:30 a.m. Eastern Time payroll release, and on that would be on Friday. If on Thursday it was a very quiet day, had a very tight range, for me personally, for the purposes of this system, between the time I start trading that day and 8:30 a.m., I would assume it's going to be a range day. Then at 8:30 a.m., I would hear the payroll number, and if the payroll number was not tradable, meaning it wasn't a significant difference, a large difference according to the news trader system, then I would say, okay, it'll be a range day for the rest of the day. If the number is in fact tradable, if it is a large enough difference, that should drive, well, in the case of the payroll, we look for a 90-point move. So obviously at that point, if it is tradable, if it is going to generate a news trade on the payroll, then I would say, okay, we move to a big day. It becomes a big day. And at that point, from that point on, we don't assume it's going to stop at 0.5. We assume it can easily keep going to 0.75 or even more. So what kind of a day will today be? You start with yesterday's statistics. Was yesterday a big day? If yes, today's going to be a big day. And you want to trade it accordingly. We'll talk about that shortly. If no, today is considered to be a range day, and you're going to trade it accordingly. And we'll get into what we mean by that shortly. If news is actually tradable from that point forward in the day, it gets reclassified as a big day, and you would trade it according to the big day format. Now, why is type of day so important? Because it tells us how to trade that day most effectively. That's why it's so important. On a range day, once again, you want to take your profits quickly, because it's probably not going to go that much further. There's not much room. You're stuck in that 0.5% at the very most syndrome. So if you wait and you're doing a trade with momentum, say, you probably don't have that far to go. And you have to be patient too, on range days, because the market will tend to stagnate a lot. There's nothing really driving it for there to be any real urgency to trade. You want to think about buying support, and your stop losses, of course, will be if the day changes from a range day to a big day, potentially, which means getting outside of the 0.5 area. You want to sell resistance, but if price gets beyond that 0.5 area, you want to close out the trades, because the potential for it to go much further is certainly there. On a big day, you don't want to be happy with 20 or 30 or 40 points on a trade. You want to try for more. Although 40 points is nothing to sneeze at, on a big day there may be much more in it. And since big days cluster, meaning they tend to occur two in a row, more times than they should statistically, significantly more, you could be looking at, over a couple of days, and probably an Asian session on top of that, you could be looking at a 200-point type of a trade. So then all of a sudden, grabbing that 40 points, it doesn't feel as good. On a big day, you're going to be looking to anticipate breakouts. We'll talk about that. So certainly, depending on the type of day it is, your trading strategy, your trading style, if you will, should be totally different. There are two totally different ways you should be trading, depending upon your view of what kind of day it's going to be. Oops. Okay, now let's look at how to identify and trade an anticipated range day. We're expecting a range day. How are we going to identify it and trade it? So why is Monday, let's say, why is Monday expected to be a range day? Okay, Friday was a range day. It stayed within the 0.5%. I calculated from Thursday at 5 p.m. to Friday at 5 p.m. that the highest the euro-dollar pair got from that opening price at 5 p.m. on Thursday was 0.4% higher, and I calculated it didn't go down at all. So it was a very tight range on Friday. There's no reason to think Monday is going to be a big day unless we have a news event. It turns out there was no key tradable news due out on Monday. Now let me be very clear on this at this point. When I say a key news event, I define that as something on my news trader system that tells me if the news is a certain amount different than expected, at least a 50-point move. I have some trades that have 35, 40, and 30-point price projection moves. They are not key news. They will not change the day. I repeat, they will not change the day from a range day to a big day. The moves are too small, and the indicators themselves are too much of a short-term nature to really drive or change the market's view in a significant way to create a big day. So for example, U.S. existing home sales, it's tradable. If the sales are way up or way down, we try to jump in and pick up 30 or 40 points, but it's not a key indicator. So there's no way, no matter what that number is, that it will change our opinion from a range day to a big day. The UK current account, it has nothing to do with the euro directly or the US dollar, and therefore there's nothing in terms of news coming out on Monday that can change Monday from a range day to a big day. So for our purposes, for purposes of trading the Euro Trader system, Monday has to be a range day in terms of the way you trade it. Of course, it could turn out to be something else, but in terms of what we're thinking, in terms of the way we're structuring our trades, we're anticipating a range day, and we're trading on expectations it will be a range day. So here's how to trade on Monday. We're going to go into the systems a little later. You have an idea of them already. I talked about them for most of you at the first seminar. But we're going to be looking at short-term momentum trades with a confirmation. We're going to be looking to take our profits quickly. 30 points would be nice, but even less if necessary. The idea is it's not going too far. If you get something decent in it, you better grab it, because it probably ain't going to give you too much more. And as it starts to whittle away, you know how you are, how most of us are. You know, you're trying to make at least 20 on it after it had 30, and you wind up taking nothing because it just continues to grind in the other direction. I think we've all been through that drill. So the idea is, on a range trading day, is try to be proactive. You know, it's probably not going to go too far. You get a little spike you favor. You got your 30 points. Grab it while it's there. If you see the price start to move, you know, and you're short and the price starts to drop, you know, put a price on the broker platform. Put a bid in there. Put a limit bid to close your position. This way, when the broker jacks the price lower to stop people out, you'll actually benefit. You'll be taking your profit from the trade. So instead of saying the broker jacked the price lower and stopped me out, you'll be saying the broker jacked the price lower and stopped me out at a profit. That's a nice thing. And again, you need to be patient. When you anticipate a slow day, be patient. Things take time to develop. Nobody's in a big hurry to do anything. There's nothing driving the market per se. And keep in mind the impact of the import-export transactions, the impact of the bank option traders and the hedge funds and the big speculators. Their impact's a lot greater. So a lot of the moves on the range day, they are very temporary of nature. They can be, the moves become a little exaggerated when the volume starts thinning out because there's a general lack of interest in what's going on. So it's okay to trade technically and take your trades, but don't try for more than the market's going to give you. My favorite on range trading days, well, I shouldn't say that. My favorite is definitely trading with momentum, confirmation trades, even on the range trading days. But I also very much like to buy support and sell resistance. We'll talk about Jimmy's bands, how we identify support and resistance. We'll get into that. But the Jimmy's bands, they do work extremely well in a range trading market. So basically, we're anticipating that prices will reverse when they get into support areas and resistance areas. And we'll talk about some methods for confirming the reversals or just jumping in, and under what conditions you would just jump in and what conditions you would wait for a confirmation. Now, how to identify and trade an anticipated big day? Let's look at Monday, the following Monday, September 25th. This is a different week. Okay, Friday is expected. Why Friday is expected to be a big day? Okay. I got a little error here, I see. This should say Friday because this says why Friday is expected to be a big day. Okay, so I got a little error there. I got to fix that one. That's slide number 46. Let me write that down. Slide number 46. Okay, why Friday? Let's say Okay, let's call it Friday. Why Friday is expected to be a big day? All right, Thursday was a big day. On Thursday, the euro had gone up over 100 points, right? So now you're looking for Friday to be a big day. Now, on Friday, interestingly enough, there's no news out. There's no key news out. There isn't any news out at all. But Thursday was a big day, so you must respect the fact that Friday could be a big day. Now, how do you trade it on Friday for the big day? On the short-term confirmation momentum trades, be patient. Try to get 50 points out of it or more if the trade's working well. Be mindful of the fact that a huge move in the opposite direction of your position is possible. So on a big day, you could have a trade on, have some money in it, but the big day move could be happening in the other direction later in the day, and you want to be mindful of that. That if it's supposed to be a big day, you got a nice momentum confirmation trade going, but you can't seem to get more than 20 points in it, and it's just lollygagging around. You want to be aware of the fact that the big move for the day could be in the other direction. So always keep that in mind. That you may be anticipating a big day, but the big day may turn out to be in the opposite direction of what's working for you at the moment. You're going to look for breakouts of support and resistance on a big day. With Jimmy's band, we're going to identify the support and resistance areas. We'll be talking more about that shortly. We anticipate that price is going to break beyond these support and resistance areas. We'll talk about that more because I'm not a big fan of trying to play breakouts, even if I think it's a big day. We'll get into that. Thinking outside the box, you always want to ask yourself, I've explained some statistics to you so far, but you want to ask yourself, are the statistics lying to you? Because many times, the statistics, in fact, are lying to you. So what you want to do is you want to look at it from a practical point of view. The question I need to ask myself, when I look, I have Monday here. One slide is wrong. We're still talking about Friday. When I got to ask myself is this. I'm anticipating. Yeah, this is a little out of sync here. I apologize for this. Okay, we're talking about Friday. So what I'm saying is, this is a little out of sync here. Let me tell you what my thought was here, though, and I don't know how this got screwed up, but it's a little screwy. But try and follow me here. We looked at Thursday and we saw that the market had moved quite a bit. It had moved 0.89%, which is about 105 or 110 euro points. And we're looking at Friday and we're saying, okay, if on Thursday, and I hope I'm not screwing up Thursday, Friday here. If I am, I apologize. On Thursday, it had moved more than 100 points up in euro dollar. So on Friday, we're going to look for a big day. Now, when we look at Friday, we see that there's absolutely no news out, nothing. And you say, how is this going to be a big day if there's no news out? Right away, I'm suspicious. Then I said, okay, let me look at what caused Thursday's big move. Now, here are the facts. All right, let's look again at Friday. All right, we got a little out of sync here. Let's not worry about it. Let's start here. Let's look again at Friday's outlook. We anticipate a big day because Thursday was a big day. No news out on Friday. Right away that you should have your doubts about Friday being a big day if there's no news out of any significance. Or there's a reason to think that this big move from the day before reverse, thereby causing a big day on Friday, then okay, maybe Friday can be a big day. But if you think that move on Thursday was a one-shot deal, and you could identify why that move occurred on Thursday, and you don't think it's really that significant, or will have a huge impact on Friday, then you can still trade Friday as a range day, but you just need to be a little more careful about the way you do it. So here's your facts. Very little happened on Thursday prior to the release of a non-key indicator, the Philadelphia Fed survey, at 12 p.m. Eastern Time. So as of 12 p.m. on Thursday, as of the day is pretty much over, everybody's gone home for the trading day of Thursday, the market hadn't moved much at all. It was a very rangy kind of day. Now, the Philly Fed index was much worse than expected, and it did signal a news trade and a potential move of just 25 points or so. Now, what happened on Thursday was, in reaching this 25-point target, it broke an 8-day high in the euro-dollar pair, and that triggered a lot of stop losses. But looking at the chart, it was crystal clear that on Friday, looked really rock solid to be a range trading day. Let me show you what the charts look like. So here's Friday. The outlook is no news. We had a big day yesterday, so we're looking for it. So today's supposed to be a big day. We got this huge move. You see, but what caused this move was it was a small day, then the price was right here. And by the way, incidentally, when we're looking at 4-hour charts, which most of these charts will be for the next period of time here, 6 bars is a day. Okay, 6 little bars here is a whole day. So you can see if you count back before this news, 1, 2, 3, 4, 5, 6. The day, it was up on the day, but it was only up about 40, 50 points. It wasn't, it was a very rangy kind of day. Now, 12 o'clock in the afternoon, the Philly Fed survey comes out, and it's trading in the 30s, so it should go into the 50s based on our news trading system, which it did. And once it did, it broke the high since the 7th. So it broke like an 8-day high or 9-day high, and getting above this price triggered some stop losses. So in the 1 bar we got all the way up to 90. So this created, because the day started off here, it was already up about 30 or 40. This extra 60, 70 caused a 100-point day and gave it the big day, the tag of a big day on Thursday. But looking at this, I say to myself, what are the chances of Friday being a big day? I put it at slim to none. No reason to think this was anything more than some short-term traders who had positions open in this area getting stopped out. And getting into this area is a whole new ball game. So I don't see this being able to rush up 100 points. I don't see it rushing down 100 points because you got good support right here. So I anticipate for Friday from here to here, on normal range kind of day, is about all that's reasonable to expect. And again, this is thinking outside the box. This is taking the statistics and making sure that the statistics are not lying to you. There's your 8-day high. So in terms of a Friday, I compute my Jimmy's bands, and I say that this is the 0.5, the R2, this is 0.35, the R1. Then on the other side, same thing. And I look at these levels and I say, how do these look for Friday? And I say, this looks perfect. If it got into this area, that would be a good level for it to stop on a given day. And incidentally, every 6 of these is a day. So you can see that from the size of these for the days, most days, this kind of a distance is about all you're going to get. You can just see that from looking at your chart over time. So I look at this. This looks like a great support area for me. Now you see this little dot here, it's just a little tiny smidgen less than my S2. I simply change my S2. So if my S2 is 15 and that little point there is 13, I just simply say S2 is 13, and I trade the 13 level, that prior low right there, as my S2. Because in the end you're going to realize if you're basing it over here on the 5 p.m. price, The price at 4:59, 1 minute earlier than 5 p.m., could have been 2 points different, in which case you would have come up with 13 because you're just doing a straight mathematical computation from this 5 p.m. rate. We'll get into Jimmy's bands. We'll explain it in detail, showing you exactly how to calculate the bands, what the bands mean, the theory behind them. All of that we will do today. But for now, I want to give you the overview of how the system works. So that's my game plan for today. This is what I told people in the review preview. I expect it to be a range day, but we have to respect the fact that yesterday was a big day. So we'll only take a trade if we get confirmation. If it goes up into the resistance band or it comes down into support band, we'll wait for what's called a 3-bar reversal, and we'll talk about what that is shortly. So we're going to focus on momentum confirmation trades and carefully consider selling R1 and buying S1 trades. And I use a shorthand of selling R1 and buying S1. Doesn't mean you have to sell it right here with a stop above here, or buy it right here with a stop beyond there. You can do that. That's okay. But for purposes of trading it, the way I like to trade it is I identify this whole area as a resistance area, and this whole area in between S1 and S2 as a support area, and I consider getting beyond R2 or getting beyond S1 as a point at which my theory or my reasoning that it was going to be a range day, which I define as staying within R2 or S2, somewhere in here, is wrong. At which point I abandon any attempts to stay short if I'm short, or any attempts to stay long if I'm long. Here's what actually happened on Friday. Here's our bands. Here's our R2. It went up and touched into the R2 area, came right back to R1 area, a little bit into the band, didn't get anywhere near R2, so we would have had a sell, we would have had a potential sell signal in that we got up to R1. And let's see how that played out. Here's your S1, S2. You'll find on most days, I think I've seen it maybe once a month on average, that you'll actually get into both bands on the same day. Usually the market tends to move in one direction or the other. Very seldom will it start off here, go up into here, and come down into here. Usually it's always one direction or the other on a given day. Anyway, we did touch into the R1 area on Friday. No news or anything. We did get a little follow through from Thursday's big spike up. I guess some more stops kicked in. We did get up into this area, and then it fell off. So you can see we had an opportunity for a good support resistance trade. Had a little momentum, a little buy signal there. But this is the one we're interested in here. We'll talk about this later, but when you get a buy signal from a momentum confirmation trade, which we'll talk about shortly, one place you can take your profits will be when you get into your resistance area, especially, of course, if you expect a range day. If not, you want to hold on. You expect it to go through the range. It's through the R1 and R2, so you may want to hold on if you expect a big day. But if you're anticipating a range day, certainly the R1, R2 area is a place where you take profits on long trades from a momentum confirmation point of view. It bounced off the R1 nicely here, went back, revisited it, and it bounced off it a second time. Potentially two good trades there for you. Now, another thing that I work with is, and we'll get into this a little later, is what I do is I measure the swings that occur during the day, because one of the systems we're going to be talking about, momentum confirmation, works with the highs and lows for the day. And as the day progresses from 5 p.m., we'll get into the time frames we trade and the rest of that shortly. But as the day progresses, we get further and further away from the highs and lows for the day And so in order to find trades that get triggered, I look at swing highs and lows. And what I simply do is I'll explain this again later, but I look for any time the euro starts off the day 5 p.m., the first move of 20 points starts to swing in whatever direction that is. And each time from the high point, if my first swing is up, the first time I go down 20 points from the peak, that becomes a swing low. And as long as it doesn't from any low point go up 20, it'll continue to that low bar, that low arrow will continue. So in this case, for example, it started off here, it went up about 20, so you're starting a swing high. Didn't go back down 20. Didn't go back down 20, but it did go down at least 20 here. So for this whole period, that's one swing because it went in one direction without ever reversing by at least 20. This is another swing because it went down at least 20. Now, that swing ends when it goes back up at least 20. So these are called swing highs and lows. See, so here, that's a potential trade for you. That swing there, when you started to come down, you would get in here. Now, it didn't reverse by 20. Here it went down. This is only about 18, so you still don't have a reverse. And as of the end of the day, you're still in this one swing back down again. You start to see when you do swing highs and lows, if you choose the right amount to attach to validating a swing, that the day looks a lot simpler. It went up, tried to go down, tried to go back up, failed, and went down. That's what happened the whole day, 24 hours. And these two, here's your R1, and these were your potential trade areas in there. This is a 3-bar reversal. I don't know how many are familiar with a 3-bar reversal, but this is what I use when along with candles. I think candles are good if you're familiar with candlestick patterns. Certainly when you're in your resistance area and you see bearish engulfing, or you see a hanging man, or you see tweezers, or any of the other dojis, anything that's a relevant candlestick pattern. If you don't have a knowledge of the candlestick patterns, I suggest you go to Google and you put in candlestick charts or candlestick patterns, and there'll be more articles on it than you can shake a stick at. I mean, that this information is totally free and available on the internet for you to learn about the candlestick patterns. And if you're going to be a short-term trader, I strongly recommend that you do learn about the candlestick patterns. Now we're going to finish up a couple more slides and take a 15-minute break. I'm very adamant that I don't talk for more than an hour and a half before I give you a break. So I'm just going to cover two more slides, if you'll bear with me, for approximately 3 more minutes. All right, so here's how it works. When you go to R1, you're looking to put on a trade. You're looking for a sell trade. But because today could be a big day, you don't know if, in fact, putting on a sell trade is the right thing to do. So what you do is, if you get a new low for at least the last 15 minutes, then you assume that perhaps it doesn't really want to go higher, and yes, there will be a reversal trade of some kind from this R1 level. So what you do is, from this, as soon as it touches this level, you count back 3 bars, 1, 2, 3. You identify the lowest level, and you say, if this bar gets through there, I'll sell and go short. And of course, you would put your stop loss above the R2 level, and you could determine how many pips you're going to risk. Now, when you use a 3-bar reversal, you don't count inside days. But incidentally, don't be afraid of any of this, because when you get your copy of the tape, when you ask me questions, when we have our free seminar, anything you don't understand, we'll go through in great detail. So if you're not getting it the very first time, some of the concepts, don't sweat it. If you're not getting anything we've talked about so far, remember, we're going to go through all this, and then I'm going to go through 6 weeks of actual trades day by day by day, and you'll see more examples of these things, and it will become clearer. And certainly by the time you get your tape and listen to it, it'll be crystal clear. So don't feel you're getting left behind here or something. If you're not getting one thing, don't dwell on it. Just try to focus on what it is we're talking about now, because we will be going over these same things quite a number of times. I designed it that way purposely with you in mind, that perhaps some of you don't have a lot of experience, and you're looking for a slow education, if you will. And again, the next little free seminar I'll definitely have stuff in there to appeal to some of you who feel this is maybe a little basic. So we are going to accommodate both here. Okay. 3-bar reversal. So an inside day simply means that the bar is totally inside the one to the immediate left of it. In this case, right here, can you see how this bar is totally inside of this one? They're exactly the same. Can you see how this one is inside of that one? Can you see how this one, because it's higher than that one, is outside of it? An inside bar, this is inside totally, this one here is totally inside of the one to the left, so it doesn't count in terms of counting your 3 bars in coming up with your low or your high. In this case, we're starting here, we're saying, okay, the first time the price for the 3 bars prior, but it's the first time the current bar price goes below the low, because we're looking for a sell trade of the 3 prior bars, we'll jump in and sell. So help me out with this. Here we're making a new high, so we're not doing anything. Nothing's cooking there. This looks pretty low, so we start counting the bars. 1, 2, 3. These well, we go here, we say this is an inside bar. This one is totally inside of that one. So this would be 1, 2, 3. So right here is still a low. Nope, no good, no trade. We keep going. We look at this bar. Well, it's not even lower than the bar before it, so we're not going to get a sell signal there, nor there, nor there. Here, if we count back, this is an inside day, so we count 1. This is inside day, so it's 1, 2, 3. These 3. What's the lowest? Right here. What's the lowest we got? Right there. Trade? No. This bar here, if you count, we count it up, we've got 1. We got 1. This is inside of this. This is inside of that. So this becomes 2. And this one here becomes 3. So 1, 2, 3. There's our 3 bars. What's the lowest price of those 3 bars? This price right here. Did we go through it? Yes. Okay, so you get your signal 1 pip lower than that low. So right here is where you would go short. There's your sell signal, because you're lower than the 3 prior bars, including or excluding the inside bars. The inside bars don't count because nothing happened. See, nothing happened here because it was totally inside of this one, and nothing happened here because it was totally inside of that one. Now something happened here, the price went higher. Something happened here because the price went lower than the prior bar, and something happened here because the price went lower than this bar. So something happened here, something happened here, and something happened here. Of the last 3 bars, when something happened, what was the absolute lowest price? This price. In the current bar, did it get through this price? Yes, it did. So I sell right there. If you don't get this, don't sweat it. I will go through a few more examples during the day. But this is a very good way to enter trades. It's also, incidentally, a very good way to exit trades. Okay, now here's that second move of the day. We saw a second move up to the R1 level. And let's see if we can do this by... Actually, what we'll do here is we're going to take our 15-minute break. I'm going to leave this slide up for you. And after you finish your break... I'm a bit of a slave driver, I admit it. I'm a little bit of a workaholic. especially with a new team coming on board. After the break, I'm going to explain where you would get in this trade. You went back above your R1, so you're looking for a sell trade. Using a 3-bar reversal, where would your entry point be? And you would start with this bar. I'll help you with the first bar and say count back 3. 1, 2. Inside day, it's inside of this one. Inside day, it's inside of this one. This one here is outside of that one, so 1, 2, 3. Here's our 3 bars. What's the lowest price down here? That would be your sell. In the current bar, did it get below here? No, so you don't have a trade. Next one, and we'll take it from there. We'll leave the pointer right there.